Hello, hello, everybody out there on my real estate and finance dorks. Welcome to the Texas Real Estate and Finance Podcast. I'm Mike Mills with Mike Mills Mortgage and Finance, and today we are going to be talking a lot of loan stuff. A little bit. I brought the enemy in with me today, but we're going to talk about loans. We're going to get into interest rates and the market, and just kind of where we're at with everything. From two loan officer points of view, and hopefully we won't get into a fist fight is what I'm looking for right here. So, but welcoming today is Mr. Gary Pierce.
How's
Gary,
it going?
how are you doing, man?
Awesome.
I got to give you the clap. Sorry,
Yeah,
part of the normal thing.
That's the first applause I've ever gotten, especially in this market.
Yes, everybody's just depressed when they call us, right?
Yeah.
I got to call the guy and talk about 7% interest rates. Lucky me.
Yeah.
Well, man, thank you for driving all the way out here. You live in Weatherford, right?
I do.
Okay.
Yep.
Yeah.
Yep.
So it's a little bit of a haul, about 40 minutes.
About 45.
45
Yep.
minutes. Okay.
Yep.
It's not too terrible, but it's farm and ranch stuff, and that's what you do. So Gary is he is a broker, a mortgage broker here in Texas. His office is based in Weatherford. He specializes in farm and ranch. I'm an independent mortgage bank, and Gary's a broker, so we're a little different. We'll kind of explain some of those differences a little bit so everybody understands that. But we're both loan officers, essentially, both knee deep in loans every single day. So I'm sure we're going to have a lot to talk about and kind of get into some special programs and get into where rates are, where we think they're going, all that kind of stuff. But let's start a little bit with the journey down the mortgage bank land. So how did you get to the place where you wanted to run your own shop there?
Yeah.
Mr.
So
Gary?
interesting concept. I was going to retire and be the old guy in the square writing some loans.
Okay.
And so that was my plan. And during COVID, I decided to go get my license. I'd always been in consumer finance, worked at LendingTree, SunTrust Bank, more marketing and business development for consumer finance products. And so I got my license, and lo and behold, another banker similar to Verity reached out and said, "Hey, we want to start up a Texas branch." And I was like, "Well, sounds interesting."
Okay.
It was a refi boom. I mean, I could fog a mirror. So I was writing a lot of loans, and so was our branch.
Yeah.
And so anyways, long story short, we did that. And then as the market shifted and our area, obviously Parker County is heavily influenced by the Western industry and performance horse industry. And so we were missing out on those kind of opportunities in the farm and ranch world. And so we wanted to be able to service that area from a loan perspective. And so we knew going out on our own was really the way to do it. And then from a cost perspective, a broker made a ton of sense, because then we could broker loans to basically a wholesale lender.
Right.
And so with that, we get great rates, we get good support, and it allows me to kind of grow the business kind of organically without having a ton of, it still costs money, don't get me wrong, but not the kind of money it takes to, prop up a mortgage bank, right? It's a whole different set of employees and things like that.
So explain that just a little bit to anybody not familiar with it, because you've been on both sides a little bit. So explain what the difference is between like a mortgage broker, because that's broker is a general term I think people use whenever they talk to someone that says, if someone says, I do home loans, like, you're a mortgage broker. And I'm like, well, no, not really. I'm not really a broker. I do a little different, right? So, but it's kind of I think it's just been around. It's just a term that's been around for a long time. But there are actually difference between, a mortgage broker, which is what you are, independent mortgage bank, which is what we are, and then like a servicing style bank, the big boys, which is like a Chase or somebody like that. So kind of in your own words, kind of explain, what the differences of those are.
I think the biggest, easiest way to understand
without talking smack about me, by the way, okay,
is definitely. No, it's well, we work very similar, right, from an investor standpoint and in a wholesale lender standpoint. But the easiest way for a client to understand it is that when we write the loan on the wholesale partner's paper. Right. It's going to say
wholesale partner being the bank that's investing in
taking the loan on. So it might be Rocket Mortgage, United Wholesale, whoever. That's where the documents are going to come from.
Right.
In the case in your situation, it's going to have your company's name on that, because that's, you guys are the bank, and then you have investors on the back end. Right. So we kind of work similar.
It's not that dissimilar, because we're going to sell our loan eventually to, most of the time, to a Wells Fargo or a Citi or somebody like that. That's going to go. They're going to service the bank ultimately, but we're not going to. we're not going to hold it. Typically we do hold some, but not very many, compared to the servicers. Whereas you guys are basically doing the same thing. The only difference is, when we close, our name's on there. When you close, it says, United Wholesale or whoever.
Right. Yeah. It's funny because the first, regular, audit we had, at my previous company, we asked the question to the regulator and said, as a broker versus a correspondent lender or a bank, what's the difference in this process? And they said, well, there was a list of 20 items that needed to be addressed. Right. And he said, you see these 20, you're responsible for 2 of them. The lender's responsible for 18. He goes, when you're the lender, you get 18 of them or all of them in that sense. So it's like, I don't know if I want to bite that much of the apple yet.
So something we can certainly agree on is how terrible the big banks and servicing banks are doing mortgages. So why don't you talk about why it's so much more of an advantage to use somebody like us versus somebody that is going through like a Chase or Wells or somebody like that?
Yeah, I think the biggest is the, cost. Usually we're going to be, usually when I'm competing against the big guys, I'm happy because we're going to win. Right. So our cost structures are much different.
Right.
We don't have the overhead. That's the biggest thing that I see, on the front end. Once you get the loan in a process, it's
massively
much more efficient. Like I've seen it over the years where you just, you get the calls, the nightmare calls from somebody and their hair's on fire. Can you save the day? And and a lot of times, not to toot our horn, but to toot our horn, because the way we're structured, we're more efficient. And it's just going to we get loans done. That's what we do.
Yeah.
Right.
There's less red tape. You don't have 600 different levels of, that's the way I explain it a lot of times too. People is just like, when I have my processor or my underwriter, my assistant or whoever, they're right there. Or in your case, the relationship that you have with the bank that you're working with is a good relationship. They want to keep it. So you have direct access to whoever you need to talk to. But if you're on the other side, it's the processor might be in Oklahoma and the underwriters in, California, and they're on different timelines. And then there's 3 levels of management in between them. And you got to call the 1-800 number and roll and through the phone tree, and all that stuff. And then they're like, I don't understand why they don't close loans on time. It's like, well, it's pretty self-explanatory for the most part.
It's good for us, right?
Yeah.
Like that's definitely,
so what's been the biggest, I guess not impact, but what's been the biggest maybe surprise of you going out on your own and actually, having your own company, running your own business that, obviously you've been in lending for a while, but participating in lending and, doing a loan and all that kind of stuff is very different than, actually being the one who has all the responsibility. So, so what's that been like for you?
So the actual like X's and O's of getting a loan, disclosed to a client and selling a rate and closing a loan has been the same. The biggest change for us is, for me personally, is I've never done any local marketing ever. So I've always worked for larger corporations, banks that we
leads are just coming in.
Well, or we were doing more online type stuff. Right. So, so the idea of working a market and penetrating a market in the time that it takes to get the buy-in, is a lot of heartburn.
Little tough sledding.
Yeah. I mean, we, my partner Willis, who he's not with us today, but I mean, he's amazing at writing loans and building relationships and doing all this stuff. And, I'm thinking from a marketing standpoint, we're going to do A, B, and C, and it's just going to take off like wildfire. But yet you got to sell yourself not only to clients, but now you got realtors involved, and you got to make sure that they're on board with you. And so, and I get the hesitation to try the new guys on the block, right? Yeah. And so we fought through that, because the other thing is like I was telling our loan officer this morning, I said, I didn't know if it was going to work. Like, we could sit here and, thankfully it's, knock on wood, we're doing okay, but it's, you just don't know, like, am I spending the time at the right places, meeting the right people?
Yeah,
So,
you can spin your wheels a lot in our business, and it's hard sometimes. I mean, there's more technology tools out there now to be able to determine,
yeah,
who's doing what business, and so
yeah,
you can kind of get a gauge on
yeah,
if people are actually, if agents specifically
yeah,
are selling, and if it's worth it. But then you also don't know. There's a lot of new people that get into the business,
mhm,
and I love working with new agents because
yeah,
you'll find people that are new to it but have a hunger. They
yeah,
have a passion for it, and
for sure.
they have a drive that they're going to be really big
Hmm.
as time goes on,
Yeah,
and you just invest a little time and make sure that you're
yeah,
providing value to them and all that kind of stuff. And,
mhm,
and that kind of stuff, those kind of relationships
yep,
tend to pay off in the long run. But
I agree.
you can also spend a lot of time chasing somebody that, you think, oh, if I can just get one deal with them. And then,
Yeah,
6 months up the road or 12 months, man, I haven't done anything with this person. And
yeah,
because it's difficult. I don't know that, it's different from a lender's point of view. I think we can maybe relate to title some a little bit and just on
yeah,
how we sell,
yeah,
simply because as a realtor, if you're an agent, you get to talk to friends and family, and
hmm,
your world of doing real estate is just everybody you can meet,
sure.
right? And
Yeah,
and not that we can't do loans for everybody that we meet,
right,
of course we can,
right,
but our primary source of business in most cases comes from realtors.
for sure.
And so when you're spending time, focusing on a particular group of agents, or this agent or that agent, someone gets out of the business or
Yeah,
someone comes back into the business. I mean, it has a big impact
yeah,
on what we do. If someone just decides
absolutely.
one day, I'm not going to do this anymore, it's like, man, that was one of my better ones,
What?
send me a deal a month or whatever.
Yeah,
So it becomes a bit of a struggle sometimes, because we always start over from zero every single
hmm,
month. There's
yes,
no I give my insurance friends a hard time.
residual,
Yeah,
right?
give my insurance guys a hard time. It's like, oh, you got that nice residual income, that
Yeah,
sounds nice. And we start at poor every single month,
right. Yeah, it is a what have you done for me lately business
Yes,
for sure.
yes. Well, that's what sales is. So
Yeah.
speaking of that though, how did you kind of get rolling? Like, how did you get into the mortgage industry or get into selling and to
Yeah.
begin with?
Well, so I started out in '05 with Lending Tree.
Okay,
So I was there
you're
for,
grinding it.
oh yeah, so I wasn't on the mortgage side,
Okay,
on the loan side, which they did have back in the day,
yeah,
a lending side of their business, but I was on the
okay,
lead side. So I was selling to, the Quicken Loans at the time, and those kind of companies, and they were buying our leads. And so
right.
that's kind of how I got into it. And then from there, I just kind of, through different business development roles, I always kind of wanted to be on origination
Mhm.
at some point and didn't know what that looked like. And then kind of like for a lot of people during COVID, like you're kind of hitting the reset button and
Yeah.
trying to figure out what's going on. And so I had reached out to a buddy of mine that's still at Lending Tree, still one of the top account managers there. And I said, hey man, you remember I used to joke around about, getting our license? I said, well, I just got mine.
Yeah.
And he's like, oh shoot, you got to call these guys. Like they need somebody in Texas, like right now. And I
Yeah.
said, okay. And so I had a conversation with these guys called Philo Mortgage, and they're great guys and they're still cranking away. But yeah, so that's how I ended up here. And then Pure Funding is kind of spun off from that. And
Yeah. So when did you guys start officially?
so
Open your doors per se.
so we started our application sometime around May or June of last year.
2022.
Our
Or yeah.
20, yeah,
Lost
so
years.
22,
Throw
right?
it away.
And then I was just talking to one of our account executives. We closed our first loan on August 28th, so almost 1 year ago today.
Oh wow. Okay.
Yeah. So next week.
Yeah.
So it's been
Almost a full year.
a full year,
We're right at
and
it.
so we're still cranking away, and I think I feel like we're doing the right things, and I love it because like I've never had a job where I was in the community and doing stuff. So we're big proponent. We get involved with the chamber.
Yeah.
We're around all the business leaders, and I mean I just love that. And
Yeah.
in our community, as you know, Parker County is fairly tight knit. It's a smaller but a lot of growth going on. So, but yeah, we've embraced it and love it.
And why did people they didn't see you walk in, but you always got the hat on.
Yeah.
I had it in the picture there, and you walked in. Man, I'm hoping we're gonna wear the hat for this. That's why I wore my Cowboys shirt. But what was it about Farm and Ranch specifically? Like, why did you decide that was a good area to kind of focus on? Did you have a background in that and come through it, or did you just end up there? How
No, I think it was just being opportunistic, right? Like, so if you look at a lot of like, which would be our competition, they can't do those types of loans the way their investors back them from an underwriting standpoint.
Sure.
So if you start talking about houses with acreage more than 10 or 15 acres, and it's not really
your standard conventional loan ain't going to work.
Yeah. And so, there's barn dominiums, right? Like that's the hot button. Everybody wants to have a barn dominium right now. And I'm like,
if I had a nickel for every 27-year-old that called me and asked me about how they're going to build their barn dominium on the land they want to find, I'm like, well, you got a couple $100,000 laying around.
Yeah. I mean, here's the thing. My builder buddies, I talk to them all the time. I'm like, hey, am I thinking about this right? But it's the same cost per square foot now that it is to build a stick house, right?
Yeah.
And they're like, oh yeah, because steel's through the roof.
Oh sure, everything's super expensive. Yeah.
5 years ago,
maybe
different ball game. Like you were building, it's kind of like having a 2.5% rate. Like it's not anymore.
Gone. Yeah, it's gone. It's gone. So what is it about? Okay, on the loan side of things, because I don't do a ton of farm and ranch myself. So what is it about? Like, what are some big differentiations if someone's looking to buy a farm or ranch? What do they need to like? What are some stuff they need to pay attention to when you're looking at that? Whether it be from issues with the loan or just regarding like what kind of loan types they can work with. How does all that work?
So there's in the farm and ranch world, there's a lot of different products, right? And so we do have a few that I feel are really good, especially for our area, because the big things, the residential loans are written just like we would. There's still the same kind of TRID requirements that you would have. They just are backed by Farmer Mac and not Fannie or Freddie.
Okay.
Right.
There's a Farmer Mac. That's what it's called.
Yeah.
I didn't know that.
So
that's hilarious, by the way.
Yeah. So they're the end investor, right? Or insurer. And they, those loans work the same way. We have the same we have the same kind of regulations as we would in a normal loan.
Yeah.
You got lender overlays where, hands down, we have to have 2 years of tax returns,
right?
No matter what.
Yeah.
Which on a
so no matter what, on conventional, you don't have to have that.
Conventional, we don't have to have it.
Yeah. So sometimes, but not. That's not mandatory. Yeah.
Yeah. So it's
are you able to take income from the farm itself and use that as well?
Yeah,
so if it's a producing farm of some kind.
Yep.
Okay.
And that gets a little trickier and into the weeds.
Sure.
But yes. And so those are your kind of your residential properties. So a lot of them where we find the niche is 10 to 15 acres or more. Let's say it's got a really nice house, 5,000 square foot home, right? And it's on 25 acres. The loan amount's going to be over the conforming loan limit. So it's above 726, right? And so jumbo loans, they don't like those over 10 to 15 acres usually. There's usually an overlay on that. And then the ag folks, the ag banks don't like it because there's not enough ag to support their underwriting.
Gotcha.
And so we've kind of found a little niche there with that product. And so we've kind of pitched that and that's been helpful for us. And then once you get out of the residential, then you start getting into kind of raw land, right? And so that's where it gets to be more of a commercial product.
Gotcha.
Versus a
residential
world. And so that takes on a whole different set of underwriting, which we've had to learn over the last year, which is it can be a little confusing because we're thinking residential underwriting processes, and so it's like getting a business loan, right? So heavy documentation,
Well, there's no insurance. I think what I run into a lot, at least with people asking questions about different types of documentation required and what banks are requiring and all that kind of stuff is, when we do a standard FHA loan, Fannie, Freddie, whatever, or Farmer Mac, we I still can't get over that name. We have it's basically insurance, right? If I do the loan correctly per their guidelines and you don't pay your mortgage, Fannie, Freddie, HUD, VA, Farmer Mac, they're going to buy the loan, right? Because we did it according to their rules. There's limitations on that, of course, but we did our job. Now, when you're talking about doing a loan for commercial, or you're doing non-QM, or you're doing whatever, well, the restrictions get greater and the rates get higher and the costs get greater because there's nobody on the backside insuring that loan for the bank. So the bank's out there, it's their neck, so they're going to do whatever they want. And I think where borrowers get frustrated sometimes, and I understand, is when you're doing one of those type of loans, right?
Yeah.
If you do a standard conventional loan, you know exactly what you need.
Yeah.
You know, you can even argue with underwriting sometimes and be like, we don't need that. This is why, you know, show them your rules, whatever. But when you're doing a non-QM or you're doing a portfolio loan or anything where it isn't falling under that category, you know, they can just say no just because they want to. You know, they've got their rules. Here are the 10 things we want. You're like, I met all the 10 things.
Yeah.
You know, usually you're fine, but there's still sense of like, we just don't want to do that.
Yeah.
You know, and it's like, okay.
Yeah. It gets crazy too. Cause once it gets into underwriting, like you've got this like laundry list of check boxes. We've got it when we submit. And it's like, all right.
Then they'll always come back for more. Oh, now I want this. And now I want this. And now I want this.
And then appraisals, can be very expensive because now you're talking about large tracts of land potentially.
Well, I bet the time to close on those is pretty big too. Only because I mean, finding an appraiser that does that specifically, that's got to be a difficult thing, right?
Yeah. So we haven't had the privilege to buy or to do a facility. Like we've done, most of ours have been land. So, 100 acres and they're going to put a horse facility on it eventually or something like that. So, or recreational land. But I know they've done the company that we work with, the lender has done, like they were giving me examples early on and I'll never it just kind of caught me off guard. I was like, man, this is a whole nother line of business to think about. But they were refinancing the company, the farm in California that produces all the milk for Costco.
Oh, wow.
And so this farm is out there, they've got their business. And so they're doing a cash out refinance to kind of help, their deal. So anyways, they were cashing out so they could, expand and
get more cows.
Yeah. Get more. Apparently Costco's selling a lot of milk. So
yeah. Wow.
But, so it was kind of and those kind of deals are not 30-day closes either.
No,
like you said, that's probably, I would guess that was 6 to 8 months.
Yeah. Well, that's almost, that's a commercial deal basically is what you're doing, right?
Yeah. It's 100% commercial.
Yeah. All those commercial loans are they take a while. It's not something that goes quickly. And do you experience, I don't know, because I know you're kind of, you guys are primarily residential, but you are starting to dabble a little bit in the commercial side because you have relationships that can handle it. Is that right?
Yeah, for sure.
So are you running into, because I've always heard from my commercial real estate guys or lending guys, especially, that because it's such a business oriented transaction, that whenever, they'll be working with somebody for 4, 5, 6 months, getting everything put together, everything's looking sharp, they got it going on, and then they're going to close in 60 days or everything's lined up. And then out of nowhere, somebody flies in with some smoking deal, and all that work you just did just goes down the toilet, if you can't obviously meet it or beat it.
Yeah. And I haven't, luckily we haven't had that happen yet, but it definitely is something, that can happen in that industry. And then, we get deals because deals get killed at the last minute too.
Yeah. You pick up the trash. Yeah. That comes.
They're like, hey, these, we got all the way through the finish line and then now they're saying this.
Yes.
And so, and that happens. I mean, it doesn't happen as much in the residential world, but in that commercial.
I mean, it happens. I mean, it's that's where, it's like I joke sometimes we're the garbage cleaners because it's you get people calling that, it's almost like a benefit that everybody in the business isn't quite as good as what you do, because then you get both. You get the phone call that says, hey, so-and-so was denied over here. What's going on? You pick up the file and like in 5 seconds, you're like, yeah, you were never going to be approved. And here's why. And they're like, why did they say that? It's like, well, because people are not good at their job.
Yeah.
And then you get the other ones that you look at it and you go, man,
this is easy.
I think we can do this. I think we can pull this off. And here's why. And here's why. And, that kind of stuff, can really help your business a lot because it's what we do every day is problem solve, right?
100%.
I mean, we're looking at a puzzle and we're trying to figure out how to make the pieces work. I don't need this. I need that, right, like all that goes into play. And when you do it enough and you have enough experience with it, you see those problems on a daily basis, it becomes easier and easier, but I mean, that's our job. I mean, I tell people all the time, like, I sell, but not really. Like I'm just, here's how it works. Here's how we can solve it. And then give me the information. We'll see if we can figure it out. Is that what you guys experience too?
That's really what it is. And that's where, like, you talk to, folks that are newer to the industry and they're like, how do I've got a loan officer assistant and she just started and she's like, week 2, she's like, how do I get better quicker? And I'm like, it's time. Like in our last company, we did, I don't know, in 18 months, 2,200, whatever the number was, refis. And all I did all day long,
Write loans.
Is we wrote, I'd write, 8 to 10 a month, and I had 25 guys on my team, and it's just as fast as you could go through them. So all I did all day long was look at problems.
Yeah.
And we're like, okay, this is how you fix that. On to the next one, on
Yep.
to the next one. And when you're an individual loan officer and you're trying to generate your own business early on, you just don't have that luxury.
Yeah.
Like, you just don't. And so,
well, it's crazy how the refi business really did. I mean, that's where a lot of really good loan officers cut their teeth, whatever period of time that occurred,
for sure,
because you're just churning and burning so many loans, and maybe a bad thing, but you can make mistakes when you're new. Not us. No, never made any mistakes. But in the beginning, you can. But mistakes happen because you're learning, and you tell somebody you can do something, and you find out later, oh no, you can't. Here it is. Here's why. But at least in those cases, the person just can't get the lower rate. They're not out of their home or whatever. So that's a really good place to kind of get your feet wet and really learn, because you're pumping through so many loans. And I had somebody tell me right when I got in the business, that you basically have to do at least 100 to 200 loans before you really start to kind of understand what you're doing. And you just got to do that many,
1,000%. Because here's the other thing that people don't realize is that they didn't write the regulations and, insert 5 years ago and haven't evolved or changed rules or changed laws. Or in the state of Texas, we have our own laws that drive our loans. And so, that stuff changes. And as much as we try to stay on top of it, one little thing, or the thing that I find is the tricky part, is when a lender has an overlay that you're not aware of.
Explain that too for anybody that doesn't understand what an overlay is, because we all play in the same sandbox basically, but not really.
So all loans are the guidelines are online. Fannie, Freddie, right?
Yep. You can
Anybody can go look at them, and that's how we have to write loans. Whatever that requirement is, we have to meet that on every. Whether it's loan to value based on property type, property purpose, loan purpose, etc. But the trick to that is lenders have overlays, and they say, okay, a perfect one is acreage, right? We're 10 acres, hard stop. Not doing anything over 10 acres. We don't like the risk. It's not our thing. And they don't understand it. So they said, we're not going to do it. Now, Fannie, Freddie, they don't care. There is no acreage overlay, right? And so I've got lenders that don't care, and I've got lenders that say, 10 acres, full stop, 15 acres, full stop. Like, it just depends.
And what trickles down to the customer is the customer says, well, I heard conventional loans don't do 10 acres. And you're like, and I understand loan officers' the approach to it, because, I think some don't know and some do. So it just depends. But if you're a loan officer and someone calls and says, hey, I want to do a loan with you, here's the circumstance. And if it's a newer one, you might say, let me check on that. You give somebody in your company a phone call and you say, hey, can we here's the scenario. Is this something we can do? And they will go, no, you can't, because it's over 10 acres. So then that loan officer comes back and goes, sorry, it's a conventional loan. It's over 10 acres. We can't do it. And then the buyer or the borrower goes, man, I guess conventional loans can't do over 10 acres. And then they tell their agent that, and the next thing you know, it just, and then you get a phone call a month later and somebody's like, well, we know Fannie can't do 10 acres. You're like, where is this coming from? Like, what do you mean? But that's how a lot of stuff in our business works. And as a new loan officer, you don't realize that until you get into it a little bit. Because when you're a newbie and you have no idea what's going on necessarily. And people are, you can do this and you can't do that. You can do this. Cause look, I would love to tell people that we sit there and read the 1004 FHA guidebook every day. And, it's just, you go look for it when you need it. And then it gets all kinds of gray areas on how you interpret this and interpret that, and whatever. But at the end of the day, your company can do what they can do. But the idea that, everybody is the same it's just not the case,
100%.
And even when you have people that can go direct to Ginny, which is FHA or Fannie or Freddie or Farmer, then, you have a little bit more flexibility. But even then, it's like the FHA credit score thing, right? People say, well, the minimum that FHA will do is 580 or the minimum 600 or whatever. There's no minimum for FHA. They don't, there's nowhere written in there that it says there's a minimum. The banks make that decision.
That's right. Cause that's a perfect example. I just got this morning, all of our lenders send out, marketing material and 500 credit score on FHA.
Yeah.
I'm thinking to myself, holy smokes, this is going to be tough.
Well, so that's a good transition to, so what do you think something like that? Cause you see more maybe than I do on the product side that come to you. Cause you can accept what you want to accept. You know, I know what we have as a company and I know some things that are out there, but I don't see the stuff that you get just in mail and say, hey, I'll do this. So are you seeing a big shift with the market kind of contracting as it has? And you're seeing like lenders get either more desperate or they're offering more products, or what are you seeing from like a corporate, management side?
Yeah. I think they're trying to get creative, right? I think they're trying to make products that are smart for everyone, right? Smart for the client, smart for them, their investors, right? Because ultimately somebody's got to hold that loan, right? And if it's bad money, then we start looking back to historical, things. And I don't think we're anywhere near that kind of product, but like, for instance, there's a 1% down product that we have available, right?
Yep.
That's a great product.
Yes.
It's conventional, no PMI. You guys probably have something similar.
We do.
So like those kind of things, I'm seeing more of that happening. The 500 FHA, that's such a sliver of the population.
Yeah.
But if you can service them and you have that product, then it's, a feather in your cap and you can get a deal done. Right.
Well, that's a good point on when you said sliver of the population, because this is another thing that I talk about a lot is, my favorite and least favorite term in the world is special programs or incentives. I love that one too. What's a new home buyer incentive? There's no incentives. Okay.
Yes. But, can you do new home buyers?
Yeah. This isn't a car, there's not any incentives, but what happens with these special programs that come out, okay, you have, the bonds and the grants, all the down payment assistance programs. And then you have the stuff that you're talking about. Like we have a 1% to 0%. We, Fannie and Freddie deal. Rates are actually pretty good on it. Costs are reasonable. They actually have give cash, all that kind of stuff, right? It's all, we have one with FHA, same deal. But there's a box that you have to fit in to qualify for that loan, and especially with some of them, there's income limits, right? And then when you walk the line of, okay, we have an income limit on this product, right? And we have a really high home values, right? And high rates. Okay. Well, then that income limit really starts to kind of butt up against, okay, can I even do this? Like, I have this product available, but like you said, for some of them, it only fits for a sliver of the population. And good or bad, I don't know. I get, I understand it, but I also get frustrated with it sometimes because, I call it chum in the water. So as lenders, we're in the business of marketing. And so we're putting out I've got this special program and first time home buyer loan and teacher loan and, calling it whatever you can. And, the reality is, when people call and you start explaining to them and you're like, well, there's this little box you got to fit in. And people fit. And when they do, it's perfect. It's awesome. But it doesn't fit everybody. And more often than not, it doesn't. So how do you handle those type of deals?
It is what it is, right? The numbers are the numbers, right? Like you can't, like it's those kind of, like you said, special programs are black box. You better fit in the box or it doesn't work.
Yes.
So what we found, and I looked, the last 20 loans and I looked at what we're doing. Out of 20 for conventional loans. Okay. 50% are conventional or FHA and the other 50% are farm and ranch stuff or non-QM, which is like bank statements and that sort of thing, and investor products. So like fix and flips and that sort of thing. So what I found is that I think, which has been great because FHA recently on their PMI pricing, right?
Yes,
in this
they get better.
I think so. That's one of the things I thought was great that the government.
But that's a benefit. Yeah, that's an actual
huge benefit.
And
it
changed for everybody.
Yeah. So most of the people that could qualify conventionally. So I just closed one yesterday. They could have been a 5% down conventional loan, good credit. And you look at it and then you start doing the math. And even though there's a PMI, you're going to have PMI either way. Right. And so you look at it and it's like, FHA is this is a good product. If you're going to stay in this house for a while, your rate's going to be about a point lower than, on average than a conventional loan. And so I feel like that's why we're seeing a lot. We've done more FHA than what we typically would have done.
The government stuff has been a big part of the market lately. I mean, not to mention just the fact, there's also the piece of, you know, a lot of the conventional deals are typically higher priced homes. And higher priced homes are typically people with a little better credit, a little more cash, you know, a little bit better situation overall. And conventional tends to fit. But then all of those people, you know, that was the thing that I don't think a lot of consumers realized, is that during the boom, you know, whatever you want to call it, when everything was crazy, 2% rates and 3% rates, if you had an FHA or a VA loan, good luck.
Yeah.
You know, good luck getting your house, you know, because there were 25 offers on that home.
They weren't looking at it. Yeah.
No, you weren't even being considered. And now in this market, as the demand has slowed because of the high rates, right? And we still have low inventory, which is a big issue. But at least now, you know, you're seeing homes listed for $300,000 that someone can offer $295 and get it. You know, or get $10,000 in closing costs, or do the buy down thing. I'm curious what, because I mentioned it in my thing. What are your I don't want to be on an island here. So what are your thoughts about the 2-1 buy down or the 3-1 buy down? Everybody's favorite mortgage catchphrase these days.
I think it's very specific to the client.
Okay.
So I don't think it's a cookie cutter. Like, I think it's one of those.
It's a good political answer. I like that.
Well, chumming the water, right? Like,
yes,
we're throwing it out there because we have it.
Yes.
So what I've seen is going to the 1-0 buy down.
Okay.
And putting more, you know, so I'm trying to remember the deal. It was like, let's call it a 750 purchase. They were putting a good chunk down, a couple $100,000 down. They negotiated about 10 grand in
closing costs.
And so we started looking at it and we're like 2-to-1 buy down. And then I said, well, why don't we split it and do 1-0 buy down and then get the rate down. And that way we're comfortable after the first year where it's not going to be this big volatile shift.
Right.
And so I think it's, you know, and then when you weigh it out, I had another client that just said, I just want it all towards my
closing costs. Yeah.
And so that's to my point. Like, I don't know if I answered your question, but I'm not skirting the question. I think they're good depending on the situation and what the client's trying to achieve.
Yes.
Right.
Yes. Well, no, that is 100% correct. It's very client specific. But I think it's client specific because every client has their buzz point or their hot button that they, you know, it's like some people just hate PMI. I'm not paying PMI no matter what.
Devil's juice.
Right. And it's like, it's $75 and you're not having to put down an extra 70 grand. What?
Yeah.
Like,
what are
we talking about? But either way, you know, it's like, okay, that mortgage insurance is terrible.
Yeah.
So my opinion on the buy down is that, you know, I don't think a lot of buyers understand because the message doesn't get relayed.
Right.
If you are the buyer and you are paying for the buy down yourself, it doesn't make sense. Okay.
Oh, yeah.
Because you're not saving anything.
Mm-mm.
You're paying the interest up front. That's all you're doing. And that never makes any sense. Right. So I wouldn't do that under any circumstances. The second piece is if the seller is going to pay the buy down, right, or the builder, because they're doing a lot of that these days. That does make sense, or I should say can make sense.
Yeah.
Because it's not costing you any money.
Sure.
You're getting a lower rate and therefore you're getting affected in a positive way and you're not having to pay for it. Great.
Yeah.
But I would always present to the people that I talk to that there's an alternative to this, which is what your second guy did, which is pay all your closing costs. If they're going to give you the money, okay, you know, it's kind of like, I always use the example of it's like winning the lottery, right? Yeah. Do you want the $700 million today?
Yeah.
Or do you want the, you know, 1.6 billion over the next, you know, 30 years? I'm taking the 700 million today.
Yeah.
You know,
give it to me.
Yes. Cause you have no idea where the world takes you, what happens, you know, whatever. So in my opinion, if I can get 10 grand, 15 grand, 20 grand, depending on the size of the loan, if I can get that money and I don't have to outlay that money out of my own pocket, it's way more beneficial than saving $100 a month or $150 a month or whatever on my payment.
And I agree. And I think what people it's hard for them to see. They feel like, I don't know if they're just maybe some of the bigger lenders out there that have traditionally sold points.
Well, they're just, right.
Yeah. So they're just, the marketing engine is train them to be like, well, how many points do I need to buy?
Yes.
Well, do you really need to? Like, I said, you know, if you go from like on a $400,000 loan from a 6 to 7% rate, it might only be like $100 a month. Well, $100 a month's $100, but at the end of the day, it's $1,200 and you're going to pay, you know, $3,000 for that. Like, why just take, I'm with you.
Yeah.
I like the cheapest rate at the cheapest cost.
Yes.
If it's 7.5,
great.
If it's 6 3/4,
whatever,
that's where we go.
Yeah.
When the market tells you to refi, then you refi.
Yes.
Like that's kind of how I.
Well, and that's the whole thing, which is again my least favorite saying, but it says, the marry the home, date the rate thing. But right. But what the point of that is that the rate that you pay for your house essentially is always negotiable. Always. The entire time that you have the loan. Now, it may not be negotiable in your favor because rates are high, right? But you can change it if you want to. If you get cash out loan, take some money out of your house, you're going to pay it. So you can always change your rate, okay? Yep. And then when the market dictates that they're better and lower, then you're going to get a better rate. Yeah. But once you outlay that $15 or $20 or $30,000, or once you pay $40,000 over for the house, okay, you never get that back.
Right.
There's no way to recoup that money at any point.
Never.
So, and especially when you're buying, I'm with you. I very rarely suggest people buy points because I just don't think it makes sense unless there's just some kind of smoking deal out there. There's some investor that just really wants to hit that coupon or whatever, like that happens, but it's rare.
Yeah. And I, like I said, we don't do a lot of selling of points, and I just don't think it's, to your point, I don't think it's valuable.
Yeah.
I don't think it's the best thing to use your money towards. Right. And, if you get seller credits these days, like when I look at the cash to close, let's say they've got, a $500,000 house, they put, $5,000 down in earnest money. And when you get to the closing table, they're pretty much only bringing their down payment.
Yeah.
Like that's a great deal.
Yes.
Right.
Yeah.
That's
awesome.
what we're trying to do.
That's exactly.
And so that's where I think on that one explanation was, they wanted to see a little bit of a relief in rate, but yet there was enough in seller credits to get rid of a bunch of costs,
yes.
Especially if you're not escrowing, the costs on a, $500,000 loan, should be somewhere in that 4 to 5 range. Right. Yeah. Like, and so, you're bringing down payment and that's it. Yeah. And it's a good deal.
So with interest rates being what they are, so I've got my thoughts on it, but I want to hear you. What are you thinking? Because it's always everybody's question. What are rates going to do?
Yeah.
What are rates going to do, Gary? What are they going to do? Where's
my crystal ball?
We've had, at the time of recording this, just so everybody knows, aside from yesterday, and I've been getting alerts on my phone about today. Today, I don't think is going very well. I haven't looked in a second, but yesterday was great.
Yeah.
Right. Mortgage-backed securities were way up, which means rates come down, but it's all relative. So, you can't even explain it that way. It's like, they're up, rates are down. Not necessarily. Pricing's a little better, but, prior to that, for the last, has it been 2 weeks, maybe?
Yeah. It's been a beatdown.
A week and a half, something like that. I mean, it's been brutal.
It's
absolutely brutal. And we had a little bit of a bounce back yesterday, but then, the Fed's meeting in Jackson Hole, they're all, all the really, really wealthy people are all getting together, deciding our fate right now. Pray to Jerome Powell that he grants us freedom. But you've been through a few of these cycles, you've seen this stuff. So what are you thinking right now, where we're at, and then where do you think we're going to, and with just, best guess, crystal ball it, where are you thinking?
I would, and I don't know if it's a guess or a prediction or anything more. Sure. It's a
educated guess.
I don't see anything that's going to really keep us in a, like, I feel like we're going to stay in a this 7-ish range for a while. Like, I don't really see, unless we see true recessionary like numbers, and we can go down a whole nother rabbit hole on how things are reported and
like the job numbers
that are
always fibbed.
Like
my favorite was last month, by the way, which was we added, what was it? BLS was like 100 or 200,000 jobs, 295,000 jobs, right? Oh yeah, we had a job. And then you look down a little bit and you see that 600,000 of those jobs were part-time jobs.
Yeah. It's
it's insane.
Yeah. So the indicators, I mean, the biggest thing tomorrow is, if Powell comes out, which I think they're going to, like, they've been so hawkish anyways. I don't.
Oh, they're not cutting rates anytime soon.
No. I'm not suggesting that. What I think the market is going to be is they're just waiting to jump off the bridge one way or the other to, like, oh, he thinks inflation's under control, or every little word they say, they hinge on it. So it puts 10 days of, bad market movement or 10 days of good. So I think we're going to stay in this kind of range for a while.
Yeah.
I think, and then you've got another external factor next year is the election. So gosh knows
what kind of
what's going to come out of that
is happening there.
And so, I always tell my guys, control what you can control. There's going to be a buyer and there's going to be a seller.
Yeah.
And we just got to be in the right place at the right time to take advantage of that from a sales standpoint. And that's why I tell them, but I don't, the ideas of being at 5% or 4.5% or what everybody was talking about first of the year. I mean, I kind of, that Kool-Aid got stale pretty quick. So.
Yes. Well, and that unfortunately, because I think that was a little bit of and I don't know how you guys did it there, but I mean, even with us in our company and I know other companies as well, there was a little bit of, hey, I know things are bad. Right. They're looking bad, but they're going to get better. We're going to, it's recession when the rates are going to come back down. This won't last forever, blah, blah, blah. And that was 14 months ago, or, you're looking like we're coming up to 2 years here, it's a little gnarly.
Yeah.
My only thought is that, and this is just, I'm kind of a geek when it comes to some of this stuff on these jobs reports and GDP and what's being reported and what's not. And then when you look at commercial real estate and how it impacts regional banks and all the stuff that's kind of in these loans that are resetting and, these independent people that are having, and you look at bank consolidation, all this stuff happening, right? That my opinion on it is that I'm with you that we're going to stay in this 7-ish, 6, high 6, low 7s. We'll probably touch 8 a few times and fall back down. That's kind of how it works. But, and I would agree with you that we would probably run until maybe next fall, on something like that towards the end of the summer. I think we get through the summer home, if you want to call it a frenzy these days, but certainly the busy time, and then get into the fall when things slow down. And then I think you'll start to see, because then we'll probably have a couple of consecutive quarters of, recession, GDP numbers being down, inflation down, jobs down, all that. My only caveat to that is that if something breaks, then we have a different thing. Right. And I don't know what that thing would be, obviously, but because there's so many factors that go into this, I think the commercial real estate thing could be a problem because you do have a lot of, I think I read it was like $2.6 trillion worth of properties that are going to be resetting in the next 12 to 24 months, going from 4% interest on commercials, a little bit more, and then, jumping to 8 or 10 or 12 or.
Yeah, it's going to be big.
Whatever. And it's not even the people that can't, but it's the banks that are servicing, because I think I read it's like 80% of those commercial deals are serviced and held by small regional banks, not the big boys.
Which would make sense, right? Like that's their bread and butter.
That's what they do. And so if those people can't pay their commercial loan or they default on it, and then that bank has enough of that it affects their ability to lend now even further because their reserves are down and they can't meet their covenants. Well, then good old Jamie Dimon from JP Morgan just comes along and says, hey, I'll buy you guys and y'all can become a part of us and we'll just keep getting bigger. But that could be one thing. I do think some of the earnings, I think there's a possibility that some of the false, sugar-coated information that the, you can call it the federal government, you can call it different agencies have been putting out there about the numbers and how we're doing. I just don't think they're accurate. And then when people start to come around and start realizing that a little bit, then I think it may even get a little bit worse. I don't know, but
I mean, it's just like anything else, bad data. Like, how do you
make decisions?
Yeah. And that's where we're at right now. And like, I don't know. I think it's we've cried wolf enough. Now I'm just kind of numb to it. I'm like I said, control what you can control. And, whatever happens in DC is going to happen. Like
the biggest thing concerning to me really right now, though, is the fact that we've basically doubled our national debt in 12 months. And I don't know that a lot of people realize that. I mean, how much it's gone up. And that's why you're seeing the reason rates are going up is because U.S. Treasury yields for the 10-year Treasury is going up, and now there's a bunch of people shorting that thing too. So
that's another whole.
Right. There's just a bunch of stuff that's just kind of starting to pile up and it's going, okay, at some point the bucket's got to overflow. Right. And when that happens, it's not, and by the way, I don't even think if we do, fall off a cliff, let's call it, I don't think it's going to be like it was in 2008. I really don't. As far as like the impact to the economy, not housing, because I think we've already determined, if anybody's been paying attention, that this recession or whatever we're going through has nothing to do with housing other than it's hurting us. But we didn't cause it, right? We weren't the reason for it. Yeah. But I don't think it's going to be I think it's just going to be enough to kind of put everybody in a bad mood, really.
Yeah. I mean, it definitely, the commercial side, I think is, you're seeing, especially out West, I've got a loan officer in California in the Bay Area, and like people,
they're getting hammered.
Yeah. The commercial real estate out there. I mean, people are just leaving their leases. They're
yes.
like,
yes,
we're done.
Yeah.
Like,
guess who's buying all those up, by the way?
Yeah, exactly.
The big boys.
Yeah, exactly.
Yeah, they're getting it at like an 80% discount, which is scary too. But.
So yeah, I'm with you. I think it's there's going to be a lot more to come over the next few months, but I don't know.
The market doesn't go away. People buy and sell homes, whether it's now the only argument that I giggle at sometimes is the whole idea. You remember, the ones, I've been doing this for 30 years and we bought and sold homes at 18%. I'm like, okay, you did. That's true. Yeah. But that 18% home was $90,000. Okay. Correct. It wasn't $450. Yeah. Okay. So it's a little different. That's little different.
Tough pill to swallow.
What are you running into, like, when you're seeing people that actually don't fit in the box? What are you running into more? Is it assets? Is it income? Is it, what are you finding on the ones that you're having to turn down?
DTI. So the one, the one
debt to income, by the way.
Yeah. Debt to income. Sorry. What we haven't talked about here in Texas, especially, is taxes and insurance.
Yes.
Right.
Yes.
So, used to be, you put insurance down, you put $125 on the estimate.
Yep.
Right.
Yep.
Couple $300 on your taxes. Yep. And we're good. Today, we're at about $1,000 on a $550,000 house, depending on the area.
Yeah.
And in perspective, right, if somebody makes 10 grand a month, right, they get we got $5,000 to play with.
Correct.
Right. That includes your mortgage, your car payments, any credit card debt, personal loans, anything like that. All has to be below $5,000. So now we're, at taxes and insurance at the rates that they're at.
Yep.
Now we're at $4,000.
Yep.
Now we got $4,000 to play with.
Right.
And guess what? 7% on 350 looks like.
It's about $4,000. Yeah, we're 3,500. Yeah.
So
you don't get to have a car. You can't have a car.
Hence the FHA, right?
Yes. You get a little higher.
51, 52, percent debt to income. And so it gives us a little bit of flexibility. And so that's usually what's happening is the debt to income's hurting us.
Yeah.
And then if you look at some of the other stuff, then it's assets, because the farm and ranch, you got to have more loan, more cash to put down.
Absolutely.
They're going to want a little bit more money down. So, but I would say debt to income's the driver.
Yeah. We're kind of, that's same thing I can't tell you how many people I've pre-qualified and been like, well, you can buy a house for $175,000, and they're like, and I've had a few, they're like, oh, that's awesome. I'm like, okay, well, here's the bad news.
Yeah. Not around here.
Not around here. You're going to have to go far. I was actually, I was looking at trying to make a video the other day about, if you want to buy an affordable housing, here are the areas in Dallas-Fort Worth where housing is actually affordable. Right. And there were a few, you can probably, I looked out in Weatherford where you were, and it wasn't out, because I was taking anything basically under 300 is kind of where I was. And when you were looking at the average price of homes, there was nowhere that I could find under 200. Didn't exist.
Yeah.
The cheapest one I found, you know where Everman is?
No.
Okay, it's in South. I actually went to high school in Everman. So it's kind of one of those things where I was like, oh, really?
I should have done more research.
Yes, but like Everman, Texas, it was like, I think the average home price was like $220, $225, something like that.
Okay.
There was Venus, which is really close to Mansfield. It was a little over 300,000, but it was close.
Yeah.
But you had to get further and further out, and even like Joshua was, was not quite there, but close. But these little bitty towns, you can find it. And the only benefit that you can really have from that these days, the good news, I guess, is that a lot of jobs, not every job, you don't have to go to work. So their houses, you can buy them in Texas. We got a lot of real estate, got a lot,
plenty of it.
But it's just, you got to be willing to drive, and, and that sometimes isn't the best deal for everybody. But yeah, we struggle with that too, just finding the income, because nowadays the average consumer's got car payments, they've got student loan debt, they've got credit cards, they've got a lot of people, tax liens, because they can't pay their taxes either. They got tax debt you got to count. So what are your thoughts on, I'm curious, since I'm talking about student loans, have you seen what's coming with that? How do you think that's going to impact us?
I honestly, I've looked at it. I mean, it's gonna the debt to income, I mean, that's going to,
well, we're already counting it though,
yeah,
right?
Yeah. Well, I don't know to the extent that if we're going to have to take the full freight, right?
Right.
So if their payments, so kind of today if there's deferred payment, then we can take a percentage of that.
Correct.
If the
what is it? FHA is 0.5% of the loan balance, and then conventional is 1, or is it half to? This is always when I always get in my head sideways on it.
They changed it too, I think, where you've got to do the 0.5%.
Oh, I think it was 0.5% with Freddie Mac.
Yeah.
Freddie Mac's 0.5%, Fannie Mae's 1%, FHA is 0.5%.
Yep,
that's what it is.
And so, yeah, so I don't know. It's going to depend on how much if they're going to have a payment that is
on the report.
Because most of those times, like if you got a $20,000 deal, you're going to have a smaller payment. Yep. But if the note comes due and it's not due, but if the payment is $300, $350, that's going to be a big problem for a lot of folks.
Yeah,
and it's
well, there could be that. My only other concern about that a little bit is that I don't think it'll impact it to the same degree because people have so much equity in their house right now. I don't think they're going to let stuff go like that. But my concern would be when you start looking at possible mortgage delinquencies, because if they're adding another debt to their monthly expenditures that they haven't had for 3 years. I mean, it's been 3 years since anybody's had to pay on that.
Yeah, it's crazy.
Now they did, good or bad, I don't know. I'm not on either side of the fence on this. I just hate dumb people. But the Biden administration just came out with an act. It's called the SAVE plan, SAVE. It's an acronym. I can't remember off the top of my head. And basically, they expanded the ability for student loan borrowers to essentially defer payments for another year. Guess why?
Well, of course.
Yeah. What's happening? In the next, in 12 months from now. Yeah. So that is in play now too. Now, I still think there are some limitations to it, but it's not everybody.
Yeah.
But they're just kicking the can further down the road on this thing, and I just don't know how long you can do that.
Yeah, education right now is so expensive, right?
Yes.
And it's probably the last 20 years has gone up. Like when I hear I don't have kids, but I've got all my buddies have kids in college now.
Oh, it's crazy.
Numbers.
It's $25,000 a semester, something a year.
Oh, it's staggering.
Yes.
I'm like,
I have a 16-year-old soon to be. And so I've already started to
fill out an application.
Yeah.
Mike needs to say
yeah. Right. Yes, please. Yeah, no, we get a different perspective on stuff when we deal with consumers because we see a lot of things, right?
Sure.
We see the impact of student loans on people. We see the impact of cars and rates and what the prices have been on those. Yeah. We see the impact of credit card debt and what people are going through on that. So it's like when you look at someone's credit, you're going through their entire situation, what they pay in taxes and everything else. You see so much that you start to get this picture of stuff where you're going, man, there is, you start to see trends. You start to see, okay, this, one of the trends that I saw over the last couple of years, I think it's getting a little bit better, but nobody had any money saved. Like for a while, debt to income really wasn't as big of a deal.
Yeah.
But nobody had any cash. Nobody had any ability to, you're telling somebody, hey, you're going to need about 25 grand. And they're going, well, I don't know where I'm going to get that. Well, you have down payment assistance. The rate's a point higher, but you can use it. Like, well, I don't do that either. It's like, I don't know what to tell you here, and now we're flipping on the other side where I do think there are more people with cash. Are you seeing, I'm curious from your side, are you seeing younger buyers, maybe the Gen Zs, are you seeing them actually being in a little bit better financial position than maybe like millennials were? Because I personally have started to see that a little bit.
Yeah. I think they're, and I don't know if it's just the people that we're running into.
Sure.
Like I'm getting that kind of entrepreneur, younger real estate investor. Hey, how do I set myself up? I'm 25 to kind of that 30 range. This is what I want to do. I want to set myself up. I want this to be my investment home in 2 years, 3 or whatever. Yeah. So we're seeing a lot of that. So we've, that's fun to see. It's great. Like they can definitely build some serious wealth. I mean, it's crazy. You talk about in our area, the increase in home values. One of my clients, he just built a place, and we had to do a refi in his construction loan. And then I actually bought his house like 8 years ago, and sold it for like, I think I paid $275 and I sold it for $350. It was a cool little 10-acre spot with a little ranch house on it. And I'm like, when I sold it for $350, I was like,
through the roof.
Unbelievable. I'm like, this thing will never.
I'm a genius.
Yeah.
I'm a genius.
It hit the market this week for $595 and they haven't done a thing to it. I was like, what? I'd send him a text. I was like, I think one of us, if not both of us, may have screwed up on this one.
Well, and that's where I think, we'll kind of, we're almost in an hour, by the way. Goes really quickly, but we'll kind of wrap a little bit in that. And I think you and I are on the same page about this. And, everybody's terrified of real estate right now because of rates and because of prices. But, and I don't mean this in a negative way. It's not going to get better. Now, rates will change. They'll, they fluctuate up and down. But the cost of buying a home, unless there's some kind of radical thing that occurs. And even if it does, I tell people, we went through the biggest crash in real estate that we've ever experienced in the history of the country.
Yep.
Okay. 10 or 15 years, whatever 08 was. Right. And the houses, and especially like California and places that were severely affected by this, the properties that were worth whatever, $1 million back then that fell down to, and by the way, it wasn't that much, fell at 850, whatever. Right. Like they fell down to 800, 850. That same house is worth $2 million today.
Oh, sure.
And you just can't, you can't drive the point home hard enough when you do it every single day. And it's not because we're shills for the real estate industry, right. It's because you see it constantly, right?
Yeah. I think where you're going is the house today at 500 is going to be 580 in 3 or 4 years.
Yes.
Right.
Yes.
And if rates go down, let's say 6% in our area, our market will light on fire, and that place is going to sell for 600.
Yes.
In 2 months. If rates, that's not a prediction.
Yeah. But if it happens, that's what will happen.
Yeah. Our market, I just know because I know there's so many people waiting on the sidelines, and they're waiting for that rate to move them versus the acquisition cost.
Yes.
And not using the rate as a vehicle. We're trying to educate folks. Like my partner has this conversation all the time about what you get it for today is not what it's going to be like. Today, you're getting seller credits. Rates are 6%. You're paying way over asking price. You're coming up against cash offers. Yep. Like it's, so yeah.
Well, and to drive the point home even further, I think right now when I read the other day, and it's regional, so it varies, but there's something like almost 30% of the purchases right now are cash that are being bought up. And people are like, well, yeah, of course rates are high. I'm like, yes, that's true. But what you're not hearing in that is that the people with the cash who have the money are buying the houses, right? While everybody else is waiting
on the sidelines
sitting on the sidelines to buy the house. And so, you're at a disadvantage because you don't have $400,000 that you can just throw at a piece of real estate. You have to pay 7% or 6% or wherever it is. Right now, but it's never a bad investment. And the people that have the most amount of money right now are the ones buying up all the real estate, and there's a reason for that.
Right. Yeah. It depends. It's just like, it's anything, right? Like if you're in the stock market crashes, right?
Yeah.
And goes down and it loses, 20%, right? No different than what you're saying in the houses in California or Arizona. Buddy of mine, he bought one of those distressed properties in Arizona after, like 07, 08, whenever that happened. And that place is worth, I can't even tell you how much that place is worth now. It's
almost
just
double.
Outside of Phoenix. Yeah. I mean, it's double what it was at its peak back then.
Yes.
Right.
Yes.
And so, it depends on if you're in the long play or the short, I always tell people if the deal looks good today, it's going to be good in 30 days. So, you got to take advantage of the opportunity.
And unfortunately, sometimes you have to kind of bite the bullet if you can. And that's the one downside with all of this is that I'm talking to people that can. I'm not talking to the people that can't. And unfortunately, the number of people that can't is growing. And it's getting bigger and it's not getting smaller. And if you're in a place where you can, you should
today,
as soon as you can.
Yeah.
So, because it's just, it's my favorite is the Mark Twain quote, right? Buy real estate. They're not making any more of it.
Exactly.
So,
buy dirt.
Well, man, I really appreciate you coming by and driving all the way out here to talk a little, dorky loan stuff with me for a little bit. I usually have to talk real estate and whatever. I don't get to get into the loan weeds. So
yeah, no, it's good. I was it's always fun to do this.
Yeah. Well, we didn't get into a fight, which is great. There's enough business to be had in the market for everybody. Lenders can get along, realtors can get along. We can all be friends. All right. Yeah. There's plenty of business to go around. Doesn't seem like it sometimes, but there is, I promise. So thank you for everybody that stuck around and, got into the loan weeds with us for a little bit. We'll be back next week. And I can't thank you again enough, Gary. Thank you so much. Tell everybody where to find you, just so we have that too.
Yeah, so we're located in Weatherford, right off Main Street there, easy to find. And you can find us on the web at mypurefunding.com.
Okay. Got any socials you're out there doing? I saw
we do a little bit of
what you talk about Willis, which by the way, I need a little more of that, just so you know.
We got to get some Willis in here. So if you're out on I-20 heading eastbound from Parker County towards Fort Worth, if you look up on maybe the tallest peak in Parker County, you might see a picture of Willis and what you talking about Willis up there. And of course he's talking about pure funding and loans, and hey, he's great. So we'll have to get him on the next.
Absolutely. I can't wait. Cause I think I need a heavy dose of what you're talking about, Willis. So, all right, guys, y'all have a great weekend and we'll see you next time.